Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group. So thankful you took a few minutes to click on this link and watch the video where we're going to go over a few of the things we talked about in this week's investment allocation meeting. Every once in a while, we remind you that we do open this up to the families that we serve. We just ask that you give us a call and we'll set you up with the right private links and so forth that you need to access and dial in. But that is available. It is, I will tell you, it's quite cumbersome and it's not very exciting, but it is open as we like to be transparent in the way that we do business. So just keep that in mind if you ever have a hankering to join us sometime. Today we're going to talk about interest rates as really at the centerpiece of this table so far for the year. So we're going to spend a little bit of time on that, labor-intensive industries, and why that may be one of the things that we have to keep in mind as we evaluate sectors and companies in 2022. Growth versus value, which we saw fits and starts on in 2021. We've had such a long run of growth dominating, so definitely need an update on where that growth to value dynamic is, and then Apple and another milestone in its market cap. So first we're going to start with interest rates. And here, first thing we're going to talk about are real interest rates, which are really what matter to investors. We typically think of interest rate just as the stated rate. The U.S. Treasury is at 1 or 2%. However, what really matters is that after inflation rate. So we have seen interest rates begin to nudge up, and this is one of the things that's just truly remarkable. Even though we've seen inflation tick up into the 5 and 6% range, at least for a little bit here, we have seen real interest rates. Well, first of all, we've seen just flat out nominal rates not really budge a whole lot. Meanwhile, we saw real rates stay steeply negative. In fact, right around negative 1%. Now, there's a couple of different ways to look at this. One is to just simply take a regular bond and then subtract inflation. Of course, if you do that, now you have many magnitude of negative rates. Or you can look at simply the interest rate on an inflation-adjusted bond. Then we take inflation out of the picture, we can see what is the true real interest rates. And those have been stuck for a long time, right around negative 1%. Truly remarkable. Even 0% on a real rate is once thought as very low. But we have locked that in, and that is simply the policy that the Federal Reserve has been pursuing. Keep those real rates after inflation steeply negative and force investors out into the risk curve. And so far, they've not been able to budge that. However, we are beginning to see that change. It's very clear. We spent a lot of time talking about the Fed pivot in December, and we've got the notes from that meeting in December, which further cemented this idea that they will be shifting policy, they will be raising rates, and that has begun to move the real interest rates. So that underneath the picture of all the market activity that we've seen over the past week or two is right in that real rate camp. And you can see on this chart, so all that to say, you can look at the chart, we saw the biggest 1 week change that we've seen dating back to March 2020. And of course, that week needs a big asterisk next to it because a lot of that was recouping the crazy apocalyptic decline in real rates that we saw in the early part of March. So that was just kind of pandemic early response. If you back that out, it was the biggest weekly change in real rates that we've seen in a real long time. And that change in real rates is lifting all the tides in the interest rate neighborhood. This is the 10-year Treasury technical chart. These are the types of charts that Andrew Thrasher spends most of his days analyzing. And all the way back to late August of 2020, you can see the general move has been for interest rates to move higher. However, that trend stalled out. If you look at the beginning part, right around the middle of this chart, in the upper 1.7s, 1.8s, right around that neighborhood, when the interest rates got in there, they stalled, ceased to continue to go higher. They came back down and mostly went sideways. The significance to all of this is that what we have seen here as of late is a new high, a fresh high in interest rates. It remains to be seen if that holds, but if it does, that means it's a significant. It paves the way for another leg higher in rates. That has implications that ripple throughout the portfolio. For the most part, we have been very defensive in our bond portfolios against rising interest rates. We continue to do so, at least as the time of this writing, or at least at the time of this video, rather I should say. But it also impacts the type of companies that we look at. Now we'll pivot away from interest rates and look at stocks. And this is one of the things that we have to pay close attention to, particularly in the first quarter. And I'll come back to that in just a second. But this is the degree to which companies are labor intensive or not labor intensive. And you can see there's a stark difference between industrials and REITs. So we're looking here specifically at sales. So this chart comes from State Street. Sales per employee. The more sales per employee you have, obviously the less labor intensive you are. This is important because we're seeing wages continue to rise rapidly. This most recent labor report that came out on last Friday showed that average hourly earnings are up year over year in the mid-single digits, so north of 5%. That is a good thing for workers, but it is impacting profit margins of corporate America. The more sensitive you are to labor, the more that is impacting the business. So it very well could be, at least in the first part of this year, where we want to have an emphasis on companies that are on the left-hand side. As of the time of this video, we are more than usual focused on those groups. Those are the ones that tend to be performing. And the reason I say particularly this first quarter. A lot of companies at the end of the year, they go through, they do annual valuations, and that's when you see raises. So it is in this first quarter that companies will be doing their public quarterly calls and posting us updates on what their outlook is for 2022. And so a lot of investors, a lot of analysts will be looking the degree to which they alert investors that 2022 could see rising cost pressures. Moving now to growth versus value, one of the important dynamics we have to have right in our portfolio, and that is connected again to interest rates. So we're going to go back to that for just a second. And what we have here on the top panel is the 30-year Treasury note. And you can see there's a blue line trending down. We see a blue line trending up. And then this most recent trend where you saw interest rates again in a downtrend. On the bottom is the relative value of growth versus value. So when growth is outperforming, when it's going up faster than value, that chart is going up, and vice versa when it's going down. Interest rates are a strong influencer, and as this 30-year Treasury note begins to break above that red line, entering a possible new uptrend, that could put a downward pressure on this chart, which would mean we're favoring value stocks over growth stocks. And that is what we're seeing so far. We have repositioned to have a little bit more of a value slant. This has just been a year after year after year that's been dominated by growth. Last year was really the first year that we saw sustained and real challenging to the growth. Ultimately, it didn't amount to a whole lot. But we saw the growth sectors begin to be challenged just a little bit, and we're seeing that trend reemerge here. So we do have a value bias because I think there's good odds that we do see higher interest rates. The Fed has told us as much, and if we do, that should favor value companies over growth-oriented. Last, Apple, a company that's been in our portfolios, or many of our portfolios, for a very long time. Across the $1 trillion market cap, not really all that long ago, 2018, and it has continued to add market cap. Just as a refresher, market cap is the outstanding valuation of all the stocks. So take the number of shares times the share price, you have the overall market cap, or the value of all the stock that's outstanding. So it crossed from 1 trillion. It lost that 1 trillion mark there in 2018 when we saw a steep correction in the fourth quarter. It finally recovered that in early 2019 and held that, quickly getting to 2, and now we have seen the third milestone of $3 trillion. Something we wouldn't put a lot of stock on, but does at least get our attention a little bit. Each time it seems to have gotten a milestone, the S&P 500 has reached at least a temporary peak and seen a pullback. That doesn't mean this is going to happen. We don't take action on this, but it is interesting. And why there's a little bit of weight to that is Apple is such a big piece of the S&P 500 that it does, certainly when Apple moves, it has a big influence on the S&P 500. Hey, thanks again for giving us a few minutes of your time, especially as we spent so much time on interest rates. Usually a rather dull moment. Don't forget that you can schedule a meeting complimentary to you. Feel free to scan the QR code or give us a call at 800-928-4001. And don't forget we have a weekly radio show. It's called Consider This. You can find it on some of the radio stations around Indiana, 93.1 WIBC. Or as most people get it at a convenient podcast forum, however you get yours. Thanks again and have a great weekend.